To understand the urgency driving the climate and nature finance markets, look no further than the UN Secretary General's recent warning. The past 11 years were the hottest on record, and a temporary overshoot of the 1.5 degrees Celsius target is now almost inevitable. So, a capital allocator might ask a basic question: how much private money is actually flowing to nature to fix this? This chart shows competing 2023 estimates of private finance for nature against the massive $571 billion needed annually by 2030. Look at the gap between those top two bars. One counts strictly defined nature-based solutions, sitting near $23 billion. The other tallies every nature-labeled instrument out there, including biodiversity ETFs and debt conversions, inflating the number to $102 billion. When a headline figure can swing by a factor of 4, depending on who is doing the math, it proves the market is operating without a shared, decision-grade definition of what it is actually financing. The binding constraint on nature finance today isn't a lack of capital, and it isn't finding projects to fund. The bottleneck is the absence of rigorous, reliable measurement. For years, the corporate strategy relied on the carbon offset. The idea was straightforward. A company could cheaply neutralize its emissions footprint by buying volume-based credits from distant environmental projects. But incoming regulations, standard setters, and mounting evidence of greenwashing are rapidly dismantling that model. The market is rejecting credits that assert carbon sequestration without proving it. The new destination for corporate buyers is the contribution claim. Instead of claiming to erase a carbon footprint, a company makes a legally defensible statement that they financially contributed to verified climate and nature outcomes. This shift forces a hard repricing of nature-based solutions. It separates cheap PR assets, which are fast becoming stranded liabilities, from high-quality, bankable investments. This graphic shows the credibility ladder, the multi-step verification process required to move a project from a weak offset claim at the bottom to a strong contribution claim at the top. The first rung is additionality and leakage control. Buyers have to use spatial location data to prove a project wouldn't have happened without their capital, and that it doesn't simply push deforestation to the next county over. This strict requirement severely limits the pool of cheap project sites available to developers, but it is the necessary baseline defense to ensure buyers aren't paying for phantom credits. Moving up the ladder, we hit the 100-year durability test. To be considered bankable, project developers now have to prove an ecosystem can survive a full century of climate change. Southeast Asia is the primary proving ground for this. The region holds massive carbon sinks, but an estimated 85% of its mangroves face severe threats from land conversion, cyclones, and sea level rise. Surviving that kind of durability test means developers have to look past simple tree planting. They have to engineer long-horizon risk structures, combining blended finance layers with specialized insurance wraps. Prioritizing that long-term durability over short-term carbon yield is exactly what separates a genuinely bankable coastal structure from an asset that washes away in the next storm. Returning to the credibility ladder, we have to look past basic permanence to see how the asset itself is measured. The third rung is honest biophysical accounting. Verifying a contribution claim requires developers to move entirely beyond simple, isolated carbon yield estimates. The new standard relies on a data stack logic. Developers must actively layer together specific impact metrics, complex dependency models, and spatial location data to show exactly how the ecosystem functions. The immediate trade-off for investors is speed and cost. Building these data stacks requires acquiring specialized technical talent and paying for continuous independent monitoring, which significantly slows down deal origination. That expensive measurement layer is a hard requirement. It is the only way to give nature investments the kind of decision-grade comparability and trust that carbon markets managed to achieve a decade ago. Meeting these strict new rules forces a final structural shift in the market. Capital is moving away from trying to rebuild damaged nature and toward preventing its loss in the first place. Preventing the loss of an intact ecosystem like a peatland or a mangrove forest keeps centuries of historically stored carbon safely locked within the soil. When you compare the economics, protection operates at a fraction of the cost and with a significantly lower failure rate than active tree planting campaigns. This presents a clear trade-off for corporate buyers. Protecting an existing swamp offers fewer appealing PR visuals than a massive community planting day, but it delivers mathematically superior net global cooling. In a market that now demands verified 100-year permanence, the economics of protection have finally overtaken the economics of restoration. This scorecard shows exactly who is prepared for this market consolidation and who is going to be penalized. On the ready side are the ESG leaders and structures who recognize the new reality. They are willing to treat rigorous measurement, independent verification, and long-term insurance wraps as their primary product rather than a compliance afterthought. On the failing side are the companies still shopping for cheap, high-volume PR badges, hoping to use those credits as a substitute for the rapid phase-out of their own fossil fuel use. The scientific consensus has settled the debate. Nature-based solutions are a vital complement to emissions reductions, but they can never act as a substitute for decarbonizing a business. The transition from legacy offsets to verified contribution claims is methodologically dense and requires expensive groundwork, but it is the only path left to build nature portfolios that institutional capital and the planet will actually accept.